Okay guys, so I'm not a great photographer or a videographer, but I'm gonna try this for your sake to explain the VLAX again. So this was the case we did at the last class. Basically what we're trying to do is to find a real estate project NPV and IRR. And what are we trying to do? We have to make sure that this project is viable. Do we go ahead or not? Okay, is it a good project or is it not a good project? How do we know that? We have to get a positive NPV. All right, so the first thing we'd have to do is in an NPV is what? Get the cash flows. So we need cash flows, actual cash. All right, and what do we do? Let's say your time 0 to 3, you have a project that's going to cost you $100,000. It will give you the first year 5,000. The next year it'll give you 20,000, and the year after it will give you maybe 60,000. And you want to sell it in year 3, and you can sell this project assuming for another 200,000. Okay, how do we know if this project is a good project? I require a return of, let's say for this I want 25%. Okay, what do? We will discount each of these, if you remember from Intro to Finance, to a present and net it with the initial investment of 100,000. Okay, so this is a review of NPV. I will discount each of these. How do I discount it? I will divide it by the required rate of return, or my discount rate. So it will be 1 plus my discount, which is 25%, to the power of n. In this case, it's 1. If I combine them here, 1.25 squared. These two I will add, so it will be 260,000, and I will discount it on 2.5 cubed. If I do them individually, okay, I get the answers here. I will add them, and then I'll subtract 100,000, and that will give me my NPV. Now, this is doing it manually one by one. These together are called the discounted cash flows, and in Excel, I can just put all of these into a formula, and Excel will calculate for me the discounted cash flow. Then I will subtract the initial investment. Okay, and I showed you how to do that on Excel. Now let's try to do this for the VLAX case. So this was an introduction to NPV. Okay, so the first step, I want my cash flows, correct? So what do I get? What is the cash inflow from a property? It's the rent, which is called the NOI. Okay, and it's given for year 1 is 64,000, and I'm told that it grows at 5% per year. So the first step I will put is that I will receive 64,000, and it grows at 5%. So what do? I will multiply by 1.05 to get the year 2, which is 67,200. Multiply that by 1.05, 7,560. In year 4, if I multiply this by 105, 74,088. Okay, so try it and see if you get these same numbers. So these are my cash inflows, the cash I'm getting, the rent. All right, what do I subtract from that? I have a loan, right? So I'm paying this debt every year. All right, how much loan am I paying? So let's see, loan payment. Okay, how much am I paying in this loan? This was given to you in the problem when we did the mortgage calculator, okay, which I'm not going through in this video, but we did a mortgage calculator, and we found through the mortgage calculator that your your annual payment, sorry, was 34,670. The monthly was 2,889 point something. So if you multiply that by 12, you get the 34,670. Okay, if you don't remember how we got this, go to the video on Moodle to see the loan, the mortgage calculator. Okay, so this is the loan payment that I pay, and it doesn't change. It's the same every year, okay? Okay, now what else is a cash outflow? I have to pay cash, what? Tax, right? We have taxes that we have to pay. So how do I know what the tax is? This is another calculation. So I will stop now this video at this point and go calculate the tax and come back to this, okay? Okay, so I wrote the NOIs again, same as we did previously, all right? Now what do I have to reduce from these? So that tax is what can I deduct to reduce the tax is depreciation and interest, those two things, okay? Now in this problem, from the loan calculator, we calculated the interest, but they are also here given. And I told you, do the loan calculator to ensure that this interest rate is correct. So I have these for every year, and I'm going to copy them down here. So I will just copy the interest, 31,108, 30,812, and 3492. Okay, so this is the interest. What else is tax deductible? I just said that. It's depreciation. So I have a lot of nice Sharpies, so I can use different colors. Depreciation was given that it is per year 16,399, and it doesn't change. It's straight line depreciation, okay? So minus depreciation. Oh, this one doesn't work. Is 16,399. I'll use a different color. Okay, 16,399, 16,399, 16,399. So what I'm going to do now is subtract 64,000 minus the interest minus the depreciation. All right. I'm gonna get, when I do that, I subtract them, I get 16,220 over here, 19,693, 23,349, and 27,197, okay? So this is now my net NOI minus the interest and depreciation. This is if you look at the profit and loss statements, the income statements, you have your sales, your revenue, minus interest, minus depreciation before tax, right? So if you don't remember this, this is a review from accounting. Now I need to find my tax. The tax is set at 36%, which was given here. Tax rate is 36%. Okay, so I'm going to multiply each of these by 36%. Or 0.36, they are the same thing, okay? What I'm gonna get is 5,839 for this one. This one, when I multiply it by 36%, I get 7,089, 8,405, and 9,791, okay? Okay, so what am I going to do now? I'll just take these tax numbers and put them over here. Okay, I will just add them to over here, my sheet from the previous one. All right. Okay, so I copied the tax that I got over here. As you can see, they are the same numbers. So I just copied them here. Now, if I subtract the NOI minus the loan payment, which is the cash outflow, minus the tax because it's cash I have to pay, my net is 23,491, 25,441 for year 2, 27,485, and for year 4 is 29,627. Now, perfect. If this was my only cash flow, very simply, I would now do it to the present and discount them, similar to what the NPV does, right? You just take them to the time 0 and discount them. We can do that, but there's one component missing, which is the sale. It tells us in this project that he wants to hold this property only for 4 years, and then he plans to sell it. And he gives us here the sale price. So I have to add here one more thing before I can discount, which is the after-tax cash flow. All right, so we will do that now separately and then put this number over here. Okay, so my year 4 sale price was given at 777,924, and the cost of it is 7%, as you can see, okay, of sale price. So 777,924,000 minus 7%. I multiply this number by 7%. I will get 54,455. The net is 723. Okay. Now I want to see the book value of this property. On the accounting book, it's different than the selling, right? So the purchase price was 525,000. The accumulated depreciation was 65,000. How did I get this number? Don't forget, my annual depreciation, which was every year, was at, what was it? 16,399. That's my depreciation, right? If I add these 4 together, or multiply 16,399 by 4, I will get this, okay? So this number over here is the annual depreciation, 16,399, multiplied by 4, which is the number of years, okay? Because we are selling it after 4 years. So when I net them, this is what I get. So now I will take this, which is 723,469, which is my net sale, minus my book value, which is on the books, okay? And I will net equals 264,065. But I don't take capital gain taxes on this whole amount, all right? I will divide it into 2. All right, part of it is capital gain and part of it is recaptured depreciation. How much was my recaptured depreciation? Is this number. So I just copy it here, 65596. This is taxed at 25%. Recaptured depreciation is taxed at 25%. So I multiply that by 25% to get the tax. What is left if I subtract 264 from 65,596? What is left? 198,469. Okay, that's what's left. These two together make this number. How much is capital gain tax? It says here, capital gain is taxed at 20%. Okay, so I multiply that by 20%. When I do this, I get 16,399, okay, and I will get here 39,694. Add them together because that's the tax I have to pay together. It's 56,093. All right, so let me take this number now, okay, so that we know what is the year 4 cash flow. Okay, so let's finalize it now. Year 4 terminal cash flow, which is after sale of property. All right, what did I get net? 723. This is how much money I'm pocketing. Yeah, I sold it for this, I had to pay this much a cost, so I start with this number, 723,469. Beautiful. Now how much I'm paying in tax here? 56,093. But don't forget, I have a 30-year loan on this, okay? So I have to pay off the loan. How much is my mortgage? If you go back to your mortgage calculator that we did, and we did these interest payments, blah, 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 you will go to year 4 and you will find the outstanding balance when we did that Excel sheet is 378,862. So that's the loan balance. Okay, so that is 378,862. This minus this minus this gives me 288,514. All right, now I'm going to go put it in here. 288,514. Add them together, then I will discount them. Okay, now I will not do a manual discounting. That is done by Excel when you put the NPV calculation and you get a number finally here. And then what do we have to subtract? Don't forget, we have to subtract the initial investment, which according to this is what? 131,250. Okay, it was purchased of 525,000, of which 75% was a loan of 393,750, and the rest was an equity of 131,250. So similar to a normal NPV, you are going to now discount. If you want to do it longhand, you will discount each one of them here, add them, subtract 131, or do it in Excel with the NPV formula. And you're going to be discounting at what rate? We have to see here, what is the rate that was given? The required rate of return is 12%. So that is also given. So you will be discounting at 12%. Okay?